Did you know that investing is the foundation to building wealth? But where do you start? With so many different options available, it can be difficult to know where to begin. Welcome to Forever Finance, where we want to live our lives our own way. Whether you're new to the investment world or just looking to get started, this video will walk you through the best ways to make your money work for you. Now, $1,000 might not seem like a lot, but if you invest it wisely, it could be the start of something much bigger. But before we can start investing, we have to look inwards first. Understanding your financial situation. Before you invest a single dollar, it's crucial to understand your current financial situation. Ask yourself, do you have any high-interest debt? Do you have an emergency fund in place? What are your short-term and long-term financial goals? If you have high-interest debt, like credit card debt, it's generally a good idea to pay that off first. The interest on that debt is likely higher than any return you could reasonably expect from investing. Similarly, having an emergency fund, typically 3 to 6 months worth of living expenses, should be your next priority. This fund will act as a financial cushion, so you won't need to dip into your investments in case of unexpected expenses. Once you're debt-free and have an emergency fund, you're in a strong position to start investing that $1,000. Understanding investment options. Now that you're ready to invest, let's explore the different investment options available. High-interest savings accounts, exchange-traded funds or ETFs, individual stocks, superannuation contributions and robo-advisors. High-interest savings accounts. Starting with the safest option, a high-interest savings account is a great way to park your money while still earning a little interest. Some banks offer competitive rates, especially for new customers. While the returns are relatively low, these accounts are virtually risk-free. This option is perfect if you want to keep your money accessible or if you're saving for something in the near future. Exchange-traded funds. ETFs are an excellent way to get exposure to the stock market without the risk associated with picking individual stocks. An ETF is a basket of securities that tracks an index, sector, commodity, or other assets. In Australia, popular ETFs include those that track the ASX 200, which represents the 200 largest companies on the Australian Securities Exchange. These ETFs provide diversification, reducing risk compared to investing in individual stocks. For a beginner, ETFs are a fantastic option because they require minimal maintenance and offer diversified exposure to the market. You can start with a broad market ETF that tracks the entire ASX or focus on specific sectors like technology or healthcare, depending on your interests. Individual stocks. If you're interested in picking individual stocks, $1,000 is a small but decent starting point. The key here is research. Look into companies with strong fundamentals, solid growth prospects, and a history of profitability. In Australia, blue-chip stocks like Commonwealth Bank, BHP, and Wesfarmers are popular choices for beginner investors. These companies have a long history of stability and often pay dividends, providing a steady income stream. However, investing in individual stocks comes with higher risk. The value of your investment can fluctuate significantly, and there's always the potential for loss. To mitigate risk, consider diversifying across different sectors. Superannuation contributions. If you're thinking long-term, one of the best ways to invest your $1,000 is by making additional contributions to your superannuation. Superannuation, or super, is a retirement savings system where your employer makes regular contributions, but you can also contribute extra. Why is this a good option? Super contributions are tax-advantaged. Depending on your income, you might benefit from government co-contributions or tax deductions, effectively boosting your investment. However, keep in mind that super is a long-term investment. You generally won't be able to access this money until you retire, so it's not ideal if you need liquidity. Robo-advisors. Robo-advisors are an increasingly popular way to invest. These platforms use algorithms to manage your investments, providing a diversified portfolio based on your risk tolerance and goals. Some well-known Australian robo-advisors include StockSpot, Raise, and Spaceship. They offer an easy, hands-off way to invest, with low fees and a range of portfolio options. For beginners, robo-advisors can be a great choice because they remove much of the complexity and guesswork from investing. You simply deposit your $1,000, answer a few questions about your financial situation, and the platform does the rest. Now that you know your options, it's time to set your investment goals and determine your risk tolerance. Ask yourself, what are you investing for? Is it a house deposit, retirement, or something else? How long do you plan to keep your money invested? How comfortable are you with the possibility of losing some or all of your investment? Your answers to these questions will guide your investment strategy. If you have a short-term goal and a low risk tolerance, a high-interest savings account or a conservative ETF might be the way to go. For long-term goals, like retirement, and if you're comfortable with some risk, individual stocks, super contributions, or a growth-focused ETF could be better options. So how to invest your first $1,000? Let's get practical. When putting together your portfolio, you will work off percentages. But for our first $1,000, here are a few sample portfolios, depending on your risk tolerance and investment goals. If you're risk-averse and want to preserve your capital, put $700 in a high-interest savings account. This will keep most of your money safe and accessible. Then put $300 in a broad market ETF. This will gain you some exposure to the stock market with minimal risk. This approach ensures your money is secure while still giving you the chance to earn returns from the stock market. If you're willing to take more risk for potentially higher returns, put $800 in a sector-specific ETF. Choose an ETF focused on technology, healthcare, or another high-growth area. Then put $200 in a broad market ETF. This will balance some of the risk and volatility in your portfolio. This portfolio is for those who are comfortable with volatility and have a long-term investment horizon. Once you've invested your $1,000, your work isn't done. It's essential to monitor and manage your investments regularly. Review your portfolio. Every 6 to 12 months, check how your investments are performing. Rebalance if necessary to ensure your portfolio aligns with your goals and risk tolerance. Stay informed. Keep up with market trends and news that could impact your investments. In Australia, factors like interest rates, economic policy, and global events can significantly affect your portfolio. Avoid emotional decisions. The stock market can be volatile. It's easy to get caught up in the ups and downs, but try to avoid making decisions based on short-term market movements. Stick to your investment plan and stay focused on your long-term goals. Consider regular contributions. Once you've invested your initial $1,000, consider making regular contributions to your investment portfolio. Even small amounts can grow significantly over time, thanks to the power of compounding. Investing is a journey. Your first $1,000 is just the beginning, but it's a crucial step toward building your financial future. Check out this video if you want to learn more about small steps that contribute towards your success, and we will see you next time on Forever Finance.